Hello, this is a video on continuing our corporate model analysis. And in this video, uh, after we put in EBITDA, that the EBITDA and working capital, I want to go backwards and talk about depreciation for a minute. And when we talk about depreciation, I'm going to address this horrible issue about how to incorporate retirements in the analysis. I've got a separate kind of little page for that. And then we will go to back to the financial model and kind of fill in a lot of the financing. Now I'm going to turn the model on and off so you don't have to watch a whole lot of just typing in, but how to set up the cash balance, the debt balance, how to incorporate the minimum cash balance that I've talked about in other videos, but just how to then really put everything together with a profit and loss, cash flow, and balance sheet. I've already kind of entered these now. You know, the, you know, we have a historic balance sheet to start. That's what we all started with. I started with. And the categories in the final balance sheet, they're not the same, but every single category, with the exception of common equity and minority interest, should be identified with a closing balance, or in the case of current assets and current liabilities, just an amount, or in the case, which is the same in the case of net plant, the closing balance for the net plant, and the gross plant and the accumulated depreciation. So when we're finished with this little video, we should be so ecstatic and have this wonderful feeling that to see our balance sheet balancing. Okay? Now, if we go to the depreciation, here's the I introduced in another video, and I'm going to start with this. This is our balance. I suppose this really should be this should be 1997, our base period, and this should be this plus one. Okay. Oops. Excuse me. Okay. I suppose making the video is good. Oops. Did I didn't even see it go. Shift Control R. What happened? I didn't. Oh, I guess maybe on the top one it doesn't really work. Huh. I didn't do that. All right. Now this find initial. What this does is, if you put, I want to retire all the assets, and I want to assume that they got put into service using a growth rate of 10%, then if I would, for example, type 1 here, then it would just increase this. Now, if you did that, how about Shift Control 1? Then when we put our, this time there were no capital additions. So if I take this total amount of plant in service, F4, and multiply that by the retirements, when we do that, and then we put the same level of retirements, and we incorporate I hope this has 13 years, so we incorporate the same thing in our projection, then we end up with a, let me see where the retirements here, well this should be, the retirements should be from Oh, excuse me. Oh, well, yeah, well, that's ridiculous. So we have a negative balance. So we have to have this. So let's say this was 0.2, then we could increase the retirement rate over time, but we'd still get a at the end of the day, we wouldn't get our net plant being down to zero, which is exactly what this is. So what you can do is we can back into the retirements. Um, Actually, that's kind of silly. I don't really have to do that find initial. All I have to do is make a little goal seek. Okay, and I suppose we could do that with a function. So let's make this very last number equal to 0 by changing our little retirement factor. Okay, and then we get a number for retirements that just allows the final balance to be 0. Now, once I did that, in the assumptions, if you go all the way to the top, we have to realize that when we retire planes, the capacity won't be left. Now, I know it's very obvious almost to say, well, the retirements of the planes doesn't necessarily equal this retirement rate and all of that, but we need to somehow account for the fact, shift control R, that we're going to lose some capacity over time as our planes get old. I don't know if you agree with that method, but at least that does that. And then I think yesterday when I did this before, I didn't accumulate the retirements, so our net capacity that's available to generate revenues goes down over time. Now that's the depreciation, and then once we have the kind of the depreciation rate up here, we can put in the historic depreciation rate, see what the gross plant balance is, and see what the net kind of implied life on the assets are. So I used 13. If you take the depreciation divided by the gross plant, I should have divided this by the factor. So I actually get something a little less than 13. I'm going to leave it at 13. Okay. And here's the retirement rate we just entered. So and then we can put we're going to add some maintenance expenditures, and for the maintenance expenditures we need to do something like a remaining life depreciation. So after you put all of this in, after you enter the assumptions, then you can do the kind of key thing really in this one, and let me redo this formula. If it's the historic period, this is for the gross plant balance, then we go up to the balance sheet, and unfortunately for the gross plant balance we have the total, but then they had some aircraft modifications and some construction. So if it's the history, you just take it straight from the balance sheet. Otherwise, you can just press the down arrow. You take the opening balance minus the retirements. This is going to be our account just for the existing assets. It's kind of just like the one we looked at in the last page, so I didn't go all the way to 13 years out, but that has it. And then almost the same thing. We put, for this one, we put this is the closing balance. So we go up to the balance sheet if it's the historic year. This H5 is the historic year. Otherwise, we take the opening. So this is the kind of key thing to get the historic moving together with the forecast in a corporate model. Okay, and then we'll start the financing. So that's enough of the depreciation. Now on the cash balance, we can do almost exactly the same thing. If it's the historic year, then I just had to fill in some silly numbers here. Don't get mad. Okay. Then we just take the balance sheet number. That's the number I filled in. Otherwise, we take the opening balance plus the cash we get from extra cash in the cash flow statement minus the cash we use to fund the negative cash flows if we have them. Now the opening balance is always equal to the closing balance. Duh. Okay, and we just push Shift Control R. Now the big thing here is that the we haven't filled in the where we're going to get the cash. Now I think what I'm going to do is here, let's put the interest income rate here first. Now in the assumptions for the interest income rate, I put on this debate, if you want to get really emotional about whether this should be on the same page or another page. This is an annualized interest income rate. So when we go back to the financial model, we better say what kind of percentage of the year we have. Shift Control P, Shift Control R, and for now I'm going to make this the opening balance. Now I have a whole lot of videos. I think you've seen how emotional I get about different circular methods. Maybe put this. Okay, that's good enough. We can make it on the average balance, but I would strongly suggest before you do this, you make it on the opening balance, and then we're going to try to incorporate some minimum cash balances here. Shift Control R, and our minimum cash balance will be the cash balance multiplied by the revenues that we input. Now I expect that as of about now I lost just about everybody. Somebody might say they watched this video, but they're not going to get much past this one. I don't know why I said that, but okay, whatever, I don't care really. Then we'll put we'll do the same thing for the debt balance, where we say if it's the historic switch, then I don't know if you saw the other video, but you probably didn't watch that part of it. We put a little sum product to get the total debt. This was the sum product over here. Now I hope that our debt balance works, so I put all the debt together. What is just a little concerning, I thought they had a little more debt than this, but and then if it's not the historic balance, we're just going to do the same thing. Take the opening balance plus the amount we have to issue because we have negative cash flow minus the amount we take. Okay. And let's do this one. Shift Control R. Again. Maybe I'm repeating myself too much, but when you do this kind of stuff, don't start. I would fill in all the accounts first, okay? And then we have the interest expense rate that we'll adjust, okay? And maybe I'll just make this stupid thing a long video. Okay, and Shift Control R, and our interest expense is the same issue. Use the opening balance as you're starting to make the model, okay? And then we can have the minority interest as a percentage of the income. I know that's probably very, very crude, but we don't have any good data on what actually caused the minority interest, you could model it all sorts of ways. So now when we go to the profit and loss statement, well, we already have the revenues, obviously. Hopefully you put a nice little underline in there. We already have the cash operating expenses, and we hopefully put a nice little line here. We'll take the minus, I'll fix the formatting later. And then the depreciation expense, we should have a total depreciation expense. I should have put a little underline there, and then we can have the EBIT. This company had no taxes. They were, in the U.S., this thing called a S corporation. Now the interest expense and the interest income, I suppose I should have made a little adjustment here. So for the interest expense, I should have made a if it's the historic period, then we take the actual interest expense, which is going to be a negative, so we have to switch it around. Okay, otherwise we do this, and let's put it as a minus. Okay, so you use that wonderful little historic switch. My wonderful friend Thomas, he's not going to watch this video because he only likes project finance these days. He says, I didn't like your historic switch, but I thought it's an absolutely crucial kind of thing to do, really, in corporate models. That's one of the few innovations, I hope, in corporate modeling. That and oops, where's Shift Control R? Okay, so that's now we have the actual interest income and interest expense, and then our other income. Again, that came from one of these analyses where we do something with decide what is the last number we should use. So here's our EBT minus this plus this plus this, and then we put our minority interest here, and I think I'm gonna do the same thing. If it's no, this should work because of the way we computed the number. This times this. Okay, that's with tax rates or minority interests, some kind of calculation you have to do in the profit and loss. I would put the factor right up there, and then we can take the difference. Okay, and then let's do a couple of things. How about we might as well, no, kind of silly. Shift Control R. Now we'll insert a couple of rows, and let's put the actual net income here. Okay, and we go up and get the actual up from our profit and loss. Now that is shocking. Usually that doesn't happen. It's kind of like the balance sheet balancing that this worked. Okay, so let's put our underlines. I almost should make a little shortcut for this. Okay, but I don't want to pollute the okay, the other thing. Okay, so let's put the now finally we can put a test here. Let's make a test, and we want to make sure that this minus this equals 0, and if we want to then put the evaluation of the test here, we could put SUMIF, and we can SUMIF when it's the historic switch, so put true. You know, eventually, maybe if you believe in this kind of stuff like I do, it's almost like typing plus or minus. Okay, so we have another one of our tests here, and then let's do the okay. Now I'm gonna have to go. Suppose I'll do that with you. We need to get the change in. We need to get the total working capital here. Okay, and that's just, of course, all the current assets. And then we'll subtract the current liabilities. For the first year, I didn't have a real balance sheet, so we had to make some estimations. I don't want to waste your time with that. So that's the total working capital, and then we have the change in working capital. Okay, and that's what we really need. Okay, and it really doesn't matter what we have in the history on the on the cash flow, and then we can take so that gives us a little extra cash flow for the capital expenditures. We put in the maintenance capital expenditures right up here. That should have been another thing with that underline, and we put this in, and then we put in our since we started with EBITDA, we have to put our interest income and interest expense separately. We need this, and then we had no dividends, so our net cash flow is our cash flow before financing minus this. Now, in the history, you know, this is kind of a irrelevant thing to look at. I don't know if we could even kind of hide it for the history. And then we have the hard parts. So then we say, well, if we got some positive cash flow, we don't need to reduce our debt. So we put the only time we're going to take cash away is if the maximum of minus this or 0. So that with that, and then what we're going to do is take, well, if we have any of this, we'll take the minimum. Now, what we're going to do is I'm going to, I hate this kind of, so we test this against the opening balance. It's the minimum and maximum. And in this case, we take the maximum. So if we have some positive cash flow, we can reduce the debt. So we take that. That's gonna, and we don't reduce it more debt than we have in our balance. So we go up to the opening balance. Okay, so that's the same thing. And then we say, well, okay, we didn't have to reduce any debt, or why didn't that, so we take that cash flow minus this, just a minute, did I do this wrong? So if we have this and we used some cash, if this was negative, we would put a plus here. And why didn't we take that? No, we had no debt balance. So then we put the maximum of this, or 0. That's how much we increase the cash. Or we put minimum of equal max. Okay, now we can go and link this up. I'm not explaining this nearly well enough, and I apologize for that. I'm all flustered because I'm doing such a shit job. So and we put the cash surplus here. And we take the other cash reduction here. Shift and notice who cares about the history, because it only started affecting this. This closing balance ignored these two things. So we go to the add the debt. Just a minute. Okay. So this is what we should have. Just reduce the debt. Oh shit. I should have added the debt. So this. Oh shit. I'm gonna just a minute. Okay, so the first thing is, if we have some negative cash flow, and if we take some money out of our cash account, that's an addition. I can't believe I couldn't get that. And then if we take and we have some positive cash flow, and we take and we reduce that with debt, that's a reduction. So that's the first thing we should have done. And then when I put the here reduction and addition, I was much more careful about specifying where it comes from and where it doesn't. And now this is only a first pass. We're going to do a little bit more advanced thing next, because we're going to put the specific debt structure in. Right now it's really good. In our first case, we could pay off all the debt first, and then we the remainder goes to the cash balance. So if you look at this case, which is essentially our base case, everything's fine. Now, once we have that done, let's just quickly see how quickly we can attach these things. I haven't put the minimum cash balance in yet. I haven't put the no, just a minute, I have to put the restricted cash in separately. Oh shoot, it's still going. Oh, okay, I'm gonna do this with you, I suppose. So here's the restricted cash. I just put that in, and then what you can do is just, once you have one of these accounts, for this one, I would like to just use the last number, okay? And we can also set it to 0, and then as soon as I do that, I just take a instead of if M4, we take this. Otherwise, we take the value applied as F4. So that's how all of these accounts work. Okay. Excuse me, for the financial model, then we should have also put this in our other accounts. So shift spacebar, shift control plus. Okay, and we can just take that straight from our number here, shift control R, and we can enter that in. So when we do all of this, and I think I'm going to stop. This is just too, if anybody's watching this, I just couldn't believe it. I would have turned it off long ago. We'll I'll have you put all the rest of these in. We'll add these. And then I'll get down to common equity and minority interest. We're going to have to add an account for that. And we'll come back to the video there. Okay. Hopefully this time I'll stop it. Okay, so where were we? So I put all the assets in. I did make a couple of mistakes. Well, one or two at least. And then we can put our test the same way. Remember, sum if. But we only want to take the difference when the historic switch is true. Okay, and we can make that equal to 0. Whoops. Okay. Oh, I did have a mistake here, so shoot, I'm going to turn it off. I'm not going to have you watch me struggle. Okay, that was horrible. What I did was I made a mistake for related to the factor. Oh God. And then let's finish this off. Hopefully, if I don't, it's not funny. If I don't, I'm going to stop the video again. But to finish the balance sheet, we're going to have to put the common equity and minority interest in here. Oh, I've said this so many times, it's so boring. We add the net income, and we couldn't get this net income until we're finished, less the dividends, the closing balance. Now, as usual, we'll put an if statement, and if it's the history, we should, why don't I, as soon as I'm finished with this, I think I'm going to, if it's the history, then we'll take this. Otherwise, we go up with the arrow, plus the income minus the dividends. Okay, and okay, we'll put this in, and we can do our conditional formatting that I should have done a long time ago to show what's really the history. So we put, oh shit. Excuse me. And we better go to the left. Suppose that's the rule, just go to the left. Press this. Okay. Also true. Now that you could also just leave it out. So I made just a little tiny different pattern. So that's our common equity. Now we have to do the same thing. Our opening balance is equal to the closing balance. Shift Control R. And this time, as with the previous ones, I don't know why I just did this. The net income really doesn't matter. And it should be net income after minority interest because minority interest is treated separately. So we have ooh, this looks bad. When our common equity goes back up. Okay, and then we can have minority interest. We'll put an opening balance. Ah, come on. Ah, stop it. Stop it. This stupid thing. It's my stupid phone. We put minority income, we less the minority dividends, closing balance. This is so stupid that you have to watch this, but it's going to be the same thing with our special historic switch. If it's the history, then we go and take it straight from the balance sheet. And I don't have it in the first balance sheet. Otherwise, we take the opening balance plus the minority income minus the minority dividends. The opening balance is equal to the closing balance. And then we shift control R. And our minority income comes from our new income statement, not the last one, not the history, of course. And then I should really be looking at what happened to this. Now we'll just fill in the rest of this. So let's go get the accounts payable. And then let's get the accrued expenses. And let's get the deferred revenues. Okay, and then Alt equal to get this. The debt we get from our financing section. Other liabilities we put here. I'm acting like this is going to work. And then we'll put our minority interest from the thing we just computed. And finally the common equity from the first one. Okay, and we can take the current. I suppose we could do it like this. Alt equal. Okay. There is some really good news here. Not that good news. This worked, this worked, this worked. We have another problem, similar kind of problem here. And we'll put a test. Put the difference. Okay. Okay, and we have a little bit of a problem. I suspect it's the same kind of thing that I just solved, so then we put a test. This should equal 0. So I suppose I'm going to leave the video on. We've got an enormous difference here. Got a really big difference going on. And so something's wrong with my cash flow and income analysis. And we can, well, let's fix that. Okay, so I'm going to turn it off. It might be the end if I really can't fix it, but whatever. Okay, to make our minimum test work, you take I'm gonna just, it's probably 8 ways to do this better than this, but we take the minimum cash balance we're targeting for, subtract the opening balance, and put a test for the cash balance. And then in your minimum function, you can also make sure that you don't, this is part of the minimum function, so you can take the minimum of all of that. So if and what happens then, shoot, I think I did it wrong now. Shit, I did it the wrong way. This should have been the minimum minus the opening balance, not the other way around. Did I? Oh, fuck. It should have been the opening balance minus the minimum, okay? And then you can see it worked because the closing balance is the minimum balance here. Closing balance still the minimum balance. Closing balance now is above the minimum balance when we have some extra cash flow. Okay, so that's the minimum balance. Let's review that again. Oh shit. Uh, so you find what your target minimum balance is from your percentage of revenues, and then you take the minimum balance minus the opening balance of the debt. And in this case, what we needed to do is, instead of targeting this from the opening balance, we had to target from the lower balance, so we can only reduce the cash instead of by the total opening balance by this one. In this case, though, balance went up, so we have to put a minus here. That's okay, and it all works out. Okay, I think I'm going to stop this video now, and we'll talk about adding fixed debt issues to that model.